Little-known U.S. natural gas market rules are becoming the latest flashpoint in an environmental group's battle against pipelines it says aren't needed. The Environmental Defense Fund said in a report Wednesday that New England utility owners Eversource Energy and Avangrid Incorporated have repeatedly reserved pipeline space for large gas deliveries, only to cancel their orders for the power plant fuel at the last minute. It's a move that, the group said, amplified the run-up in electricity prices during cold snaps and cost customers $3.6 billion over 3 years. The practice is permitted by regulations meant to ensure reliable gas supply, and Eversource says it didn't profit from it. The report comes as environmental groups intensify their efforts to block new oil and gas pipelines, which they say will disturb natural habitats and accelerate climate change. Environmental Defense Fund said in its report that the 11th-hour capacity cancellations show the gas supply bottlenecks used to justify such projects may be less severe than they appear. Eversource pulled out of a $3 billion New England pipeline proposal last year after a court ruling effectively blocked funding for the conduit. There were in some instances plenty of available capacity on the pipelines serving the populated areas of the Northeast that bore the brunt of the price increase. Caroline Prettyman, a spokeswoman for Eversource, called the group's reports misleading. A spokesman for Avangrid didn't respond to a request for comment. It is well documented that New England pipeline demand greatly exceeds the supply on cold days. Gas distribution business is carefully regulated and the gas supply we purchase for our customers is a strict pass-through cost, meaning they don't benefit from higher prices derived from withholding. Avangrid and Eversource, like many utilities, lock in the rights to purchase space on gas pipelines for the long term. In 2008, the U.S. Federal Energy Regulatory Commission issued a ruling that allowed such companies to sell extra capacity not needed for customers to a secondary market, where power plants buy the fuel, according to the report. Because utilities are part of a regulated monopoly, most profits from the secondary market have to be given back to the ratepayers in the form of dividends. But when utilities cancel scheduled pipeline capacity in the last hours of the trading day, too late for it to be resold, higher electricity bills can result, according to the Environmental Defense Fund report. It's a phenomenon that may become more pronounced as the nation becomes more reliant on gas-fired generation. New England is probably the leading example in the country of what the implications of increased gas use and increased reliance on gas-fired generators are for consumers. To get faster updates and the latest news from the oil and gas industry, please subscribe to the YouTube New Video channel and connect with us on Facebook, Twitter or LinkedIn.